Welcome back to Mortgage Giants. I'm tall, he's taller. Let's talk mortgages.
So
So as we mentioned last week, we were going to break down kind of some of the CMHC insurance rate kind of talk. Want to lead us off into that?
yeah, this is something that is shockingly unknown. Everybody is familiar with CMHC. Everybody has had a little bit of discussion around it, heard about it in the news. They understand that it allows them to buy a home with less than 20% down. It's an insurance premium. They feel like it sucks to be buying a home, saving, working hard for your 5% down payment, and then you got to pay this pretty significant insurance premium.
Yeah.
And they view it just kind of as a negative. Nobody likes paying extra. But what isn't discussed, and what if I was CMHC, this is what I would have been leading with in the news or in my, whatever was being sent out to the public, is that because you're paying that insurance premium, you're getting an insured rate.
Yeah.
So what that means is that you go to buy a house, you put your 5% down, you pay an insurance premium based on your 95% loan to value.
Yep.
That premium is added to your loan amount. Because you're paying that insurance premium that benefits the bank is going to say, okay, we will give you a better interest rate than the family that puts 20% down. Because what happens when you put 20% down is now the bank has to pay that insurance premium.
Yeah.
And because they're paying that insurance premium, they're going to bump up the interest rate a little bit higher to recoup that premium. So in the end, we're all paying insurance.
Yeah.
It's just who's paying it up front.
Right.
So now a person that has paid the premium, they have protected the bank. So now let's say something happens 5-10 years down the road. Now you have foreclosed, the bank is starting the foreclosure process on a homeowner, and they list it on MLS. They go through the court-ordered sale, and if at that point the house sells for less than what is owing, that insurance premium covers the bank's losses. That includes real estate commissions, legal fees. The whole foreclosure process is not cheap.
Yeah.
So by paying that premium, it has now protected the bank.
Right.
Okay. So again, the house would have to sell for less than is owed for the bank to actually suffer losses.
Yeah.
Or even close to what's owing when we factor in real estate and legal and all the other things. So you've protected the bank from loss. Now you paid that premium. But if you've paid that premium and the bank gives you that insured rate, what's the average? We're seeing it's like 0.3% on average.
Yeah. Difference. Yeah.
Difference.
Yep.
So an insured rate versus a conventional rate, which is the term used for people that put 20% down or more.
Yep.
So if you're saving a quarter to 0.35% for 10 years, because even at your 5-year renewal, you're going to get an insured renewal rate.
Yep.
So you're going to continue to pay 0.3% less than the conventional purchase.
Yep.
You will recoup the bulk, if not all of that in premium. I've done it a few times around the math, and I feel like it's around that 10-year, 11-year mark.
Yeah.
Depending on the spread. But on average, you've saved about, what that premium would have cost you in monthly interest costs.
Right.
So that's good news. I mean, it's not just a fee that goes into the ether and you don't benefit from it.
Right.
You are benefiting from paying that insurance premium, and you stay in that house long enough, you will actually get ahead.
Yep.
Now, a couple things here are people in our country, the average person is not living in the same house for 10 plus years anymore.
Right. What did they say? Like 60% of people break their
First
5-year
5-year term.
Yeah.
I mean, so people are moving some every 3 years.
Yeah.
And maybe their families are growing and there's needs, but I also think that we have a little bit of like a restless syndrome here.
Always wanting something better.
Something better, chasing things, and as we make more money, we want to move up the social ladder a little bit. So yeah, if you stay put in a home, pay that premium, you do actually get ahead, and you will be paying to that. Now, most banks, let's talk about the big five.
Yeah.
They are going to classify mortgages into two buckets. They're going to look at the insured mortgage, which is what we just talked about, the conventional bucket, which is the family that's putting 20% or more, and then we have the monoline banks that are the non-brick and mortars. They are exclusively exist basically digitally.
Only money for mortgages.
Only money for mortgages.
No banking.
They don't want your personal banking. They're not going to sell you a credit card. They don't want your car loan. They just do your mortgage. They're excellent at it.
Yeah.
So they will reward a home buyer by putting more down payment in 5% increments. So they'll now start giving you a better rate, again, at 25%, 30%, and a 35% down payment. Now you're getting the same rate as the person that put 5% down. So it's kind of a curve. Right. I guess more like this, where you got the best rates for the 5% down family, and then it kind of gets a little bit more expensive at 20, and then it
works its way back
up to best rates at 35% down. Now they'll do this because the bank they're still paying that premium for the 35% down payment person, but that premium is so affordable. It is so cheap. Because the odds of a foreclosure happening and the sale price being a loss being experienced by the bank, because if you're starting with a 35% down payment, and the loss is very unlikely at that point. So that's why that premium can be less. So, and then those savings are passed on to the home buyer. But again, not in the big five. This is a monoline exclusive rate tiering system.
Big five is just insured, conventional.
Two buckets.
That's it.
And so we talked to a lot of families, and you got the parents in the ear, or Mr. Professional Uncle, Jack of everything, master of nothing. What's that? He's telling you, big banks, like
only way to go.
Only way to go. Don't trust them. Well, that's bad advice. Straight up. That is terrible advice at this point. You should be, compensated for parking more of your savings into a real estate investment. If there's no reward for doing that, maybe you do only put 20% down, and then you take that extra 50 grand and invest it and earn a better return on those dollars. So there's an argument to be made there. There's no benefit in putting a larger down payment. You might want to talk to your financial advisor about keeping more money invested and earning you, a greater return than what your interest rate is on your mortgage. So that's something to think about. But when you're being rewarded and you're being compensated with a better interest rate by putting more money against your property, worth exploring. For sure.
I mean, when you really think about it, somebody is benefiting at each stage, right? Because quite often people who put 20% down will find out what the insured rate is and be upset that they're not getting that rate. So yes, the insured person, they're getting the low rate, but they're paying the insurance premium, which they can benefit for in the long term. But if you're doing 20%, now you have no insurance premium, and even with the higher rate, your monthly payment is going to be lower. And then the more you contribute, there's benefits at each stage. And part of what they need to understand is that lots of this is just about risk for the lender. So if the client is paying the insurance premium, less risk for them. And as it works its way up, so it's not just about giving these people who have no money the best rate because they're special. There's none of that. This is all calculated. It's all about mitigating that risk.
And because it's so calculated, now you're going to be sitting here listening to this, and you're going to say, well, why don't I just put 19.99% down and pay that premium? You could, but it's kind of baked in. They have the calculations and the
basic 5% increments, right? So
So yes, you could put 20% down and opt to pay an insurance premium, but it often, the risk of you making a change, and then losing that premium, it's not worth it. It really is, is set up to either pay it or don't pay it. Pay it if you need to, don't pay it if you don't need to.
Right.
It's not really, there haven't been many experiences or situations where I've seen it make sense to voluntarily pay that premium. The other thing you have to remember too is that, okay, let's say you've been in that house for 8 years, 10 years.
Mm-hmm.
Your home's appreciated a little bit in value. You have paid your mortgage down. That's great. Now you want to do a refinance. You want to access some of that equity to purchase another property, pay for your kids' university, whatever.
Renovation, whatever. Yeah.
Update the house. Needs a new roof. The second you do a refinance and access equity out of that house, that premium now is gone.
Yeah.
Now you go back into conventional rates for the remainder of your time in that home.
Yeah.
So a refinance will void your insurance premium.
Right.
So super important. And also, maybe that helps you understand why you don't voluntarily pay that premium, because the odds of people accessing equity is quite high. It's a very common thing.
And it's not a common thing to hear people be in the same home for 20 years.
Yeah.
That's not the norm anymore.
Yeah, for sure. So again, and people also then, we talk about HELOCs. And so you want to refinance your house, you want to put a home equity line of credit on for future use because personal lending rates are high. Mm-hmm. The cheapest money you're ever going to borrow is always going to be your mortgage.
Yeah.
Then the second cheapest money you're going to get is usually on a home equity line of credit.
Yeah.
Okay. So now you need that money for a short-term expense. Instead of borrowing it in a personal loan, you say, okay, I want to add a home equity line of credit. I'm up for renewal anyway. Let's do that.
Yeah.
Create a home equity line of credit. So then that causes some other kind of conversations that we have quite a bit.
Yeah.
People talk about being mortgage free.
Yeah.
But they actually have a line of credit on their house.
Yeah.
So why don't you take?
And like now, when that's coming up so often, is because we are in such a high rate, high price, high demand. There's going to be lots of co-signing. And generally, it's going to be the parents or who are a little bit older say that they're free and clear, helping out their kid.
Yeah.
And then we go to access the title of the property because we have to confirm that it's free and clear.
Yeah.
And all of a sudden, there's a HELOC registered on title. Because people don't realize that a HELOC is a mortgage. It's registered on title. It just like a regular mortgage is.
Yeah.
And you are not free and clear if you have a HELOC, right? Like even if that HELOC has a zero balance, it's still registered on title.
You would have access tomorrow to pull that money out,
exactly.
which is secured against your property.
Right.
We need to know about that.
Yeah. And then now with parents or whoever is co-signing saying they're mortgage free, everything looks good. We go pull title and there's an $80,000 HELOC or a $60,000 HELOC.
$500,000.
And it's like, okay, the whole game just changed for this application because now we have to debt service that HELOC amount.
Yeah.
So somewhere along the line, there is a group of people who thought that the HELOC was something separate and didn't have to be taken into account. Well, I paid off my mortgage. It's free and clear.
Yeah, no, you still owe like $300,000 on your property.
Yeah.
That is a mortgage. That is tied to a property. And we need to see those loan payments. We need to see all that information. Yeah, absolutely.
And it's coming up more and more right now, just because of the economy that we're in.
So yeah, people are going to be leaning on their HELOCs.
Yeah.
To get them through, these high cost of living times. And then what we want to talk about too is when they're up for renewal. If a mortgage is up for renewal and there's, $80,000 on the mortgage and $80,000 on the home equity line of credit, it's probably a good time to combine those two at a renewal stage, because again, the cheapest rate you can borrow is on the mortgage component.
Yeah.
So you'll want to probably consolidate those two during a renewal and put a bigger dent in the principal pay down of that.
Like the HELOC is not something where you just sit on money that is owed, right? Like you use it strategically,
Yeah.
whether that's to like finance renovation that you plan to pay off in the near future, or you're in the home buying or renewing or refinance process, but there could be an inheritance or something, money could be coming where you can set up the mortgage part as lower, HELOC, carry a balance for a little bit. Okay, you get this inheritance or whatever might be coming your way, big bonus, pay that off. Like there's a strategy to it, but you don't just want to sit on 100 or 300 grand on a like interest only.
No.
No,
That's, if that can be avoided, it's definitely something we want to do. They're amazing products. I mean, especially when you're buying and selling. If you found your house, you're moving your family into a new home, and you've got a property that is, call it free and clear.
Yep.
But you want to take your time moving into a home, and you have enough down payment in personal cash, so you can put your down payment, buy that home with 20% down. Well, you don't want an 80% loan amount attached to that new home because you're going to sell this house.
Yeah.
Say you bought a house, your long-term forever home is going to be $800,000. You currently own your home that's worth, let's say $400,000. You're making a big upgrade. Okay, so you own your house, $400,000. It's tied up, locked into this property. Your new home is $800,000, and you have $200,000 that you are available in liquid cash to use as a down payment.
Yeah.
Okay, so you put that $200,000 against your new $800,000 purchase. That leaves you with a $600,000 mortgage. Well, you don't want a $600,000 mortgage. You know you're going to sell this house in the coming months, and you're going to have $400,000 coming your way.
Yeah.
So that's when we use a HELOC component of a mortgage to say, well, okay, let's out of that $600,000, let's do $200,000 mortgage, $400,000 HELOC, so that your
sale goes through.
You're going to get that cash, and you're going to put all $400,000 against that home equity line of credit, and you're just left with that $200,000 mortgage component, which is what you want, and it sets you up for the long term, goal. So that's an amazing use of a HELOC.
Yeah.
Now you also will have that $400,000 available for future use.
Yeah.
So now it's just sitting there. You're not paying any interest on it. It's just completely available, which is great. So that's a ideal use of a HELOC product.
For sure. And we call that maneuver here the refi to buy.
Refi to buy. Check out our website. It's on there. It's an amazing calculator.
It's a great tool, but again, like you just need to make sure that you understand it's a mortgage.
Yes.
Even though it's labeled as a HELOC, it's a mortgage.
Yeah, and there are some other. Technically, the banks can also reduce your limits if you're not using it, or if you're using it too much. Like there is some power that the banks hold on the HELOCs. They can reduce the amount available to you, and it's technically a demand loan, so they could ask you to convert that into a mortgage, line of credit, or loan.
Yeah.
It's not common. I don't know if I've ever actually seen that happen.
Yeah.
But technically it is doable and possible.
Yeah.
So something to be aware of.
Yeah. I've also seen a couple recently of banks that are attaching personal line of credits to the properties. And I've seen it twice with CIBC.
Really?
Yeah.
Okay.
So I was renewing a client, and all of a sudden this came up. It's like, it says it's a personal line of credit. It's like, no, it's attached to. It's like, it's a sneaky way to try and like keep them there, because it wasn't labeled as a HELOC or home equity line of credit on the statement. It was labeled as a personal line of credit.
For some reason, they felt like they needed the additional security.
Yeah.
Yeah. Yeah. Oh, and every bank, like they're all so different. Like they all have their creative flair.
Yeah.
They put they name it all different, and it's all the same thing.
Oh, for sure.
Is it secured or is it unsecured? Is like that's the secured debt. Think about it. If it's secured against the property, it's collateral. If you were to default on that loan, the bank has rights to go after the property for sale, to get their money back.
Yeah.
If it's just unsecured, it's literally they can sue you or they can come after you for you go into consumer proposal and they're going to get some of their money back. But it's not pretty. That's why the rates are better on secured debts.
Yeah, exactly.
Yeah. So no, they're great tools. They work wonders, but they're definitely not. You try not to have money extended on home equity lines of credit for longer than several months without a firm plan. Like you said, it could be an inheritance, it could be a promotion, maybe you're bonused quarterly at work or annually, and you just need to bridge the gap between those kind of influxes of cash.
All right. Well, thanks for tuning in. Wait for next week's episode. Don't forget to hit that like button, subscribe button. See you next week.